I found 76 pre-approved credit card offers for this year that are soft pull only. So there's no more taking hard credit pulls just to get denied or stuck with those baby credit limits. Now you can nearly guarantee approval without the credit hit that drops your score and puts you out of the game for months. So coming up, you'll see the kind of pre-approval that's basically a coin toss and shouldn't be taken seriously. The banks that treat pre-approvals like a game of peekaboo, here now and going tomorrow, and two cards that let you see your limit up front, handing you full control of your next move. And by the way, you got to check out every card that I'm going to talk about, plus so many more on my free credit card pre-approval master list. I keep it up to date monthly, and it has over 70 cards that you can get pre-approved for without a hard credit pull. I'll leave a link to that below so you can check it out. Now, have you ever applied for a credit card just to see a hard inquiry, drop your score, and then still get denied? I know it's brutal, right? That's where the magic of a soft pull comes in. So a soft pull is like peeking behind the curtain. It lets you see if you're likely to be approved before you apply and without any hit to your credit score. That means no dings, no drama, and definitely no regrets. So this is a game changer if you're building or rebuilding your credit. You're not just shooting your shot in the dark anymore. You're applying strategically, choosing which cards that are a strong fit based on real data points, not just hope. Now here's a pro tip. You can actually freeze your credit bureaus. That means with Experian, Equifax, and TransUnion to ensure that the offer stays a soft pull even after you accept it. So let's say American Express usually pulls Experian for your first card. You can freeze Equifax and TransUnion and then apply to protect your report. Or maybe you're eyeing a credit union that just pulls TransUnion. That means you can lock down the other two credit bureaus to protect them. So this kind of planning puts you in control, not the banks. And you should know when applying for credit cards, not all offers are created equal. Some are safe to try, and others can cost you credit score points if you're not careful. So here's how to read in between the lines so you know exactly what you're getting into before you click apply. Now, the first one is pre-qualification. This is we think you'll qualify. So it uses a soft pull to estimate your odds. There's no damage to your credit just for checking. And it's based on general info like your income, credit profile, and internal data from the lender. There's no guaranteed approval. So if you move forward and apply, it might turn into a hard pull. So you want to proceed with caution with that one. And from my experience, it's about 60% accurate. There's no hard pull if you stop after checking. And I also want to add that many credit unions rely on pre-qualification tools that feel more like a glorified marketing tool than real underwriting. These are often lazy pre-quals that approve nearly everyone, but still lead to denials when the full application is reviewed. So don't take them at face value unless you've seen strong real-world data points. Now, the next option is pre-approval, and this really means that you're on the short list, which is good. It's a much stronger signal than a pre-qualification. Lenders have often already reviewed your actual credit report. It's still a soft pull, and it usually based on the data that banks already have on you. The offers may include, specific terms like APR ranges, so interest ranges, and credit limits. And in my experience, they're about 90% accurate. And they are a strong sign that you'll actually be approved. And these are often used by fintech lenders and nationwide banks like Discover, Chase, and Capital One, and many others. And you'll sometimes see these via email, online tools, or even in snail mail. So the next option that you have is full approval, and that basically means you're already approved. You just have to hit accept. So these are rare, but really the new gold standard offers. You get a specific credit limit, interest rate, and terms up front. And you're already approved. You just have to click that accept button. And some fintechs offer this, but it's very rare at the moment. And so the Apple Card, which is currently backed by Goldman Sachs right now, is one of the best known examples of this. That's where they show your limit up front and the terms are clear and you just have to hit accept. The next one is no hard pull if you're denied. So this part gets missed a lot, but it's really critical. If a credit card offer says no hard pull unless you accept and you don't get approved, your credit report stays completely clean. You won't lose any points on your score. You won't spook future lenders either. And you still stay in mostly full control. Cards from issuers like Amex, SoFi, Venmo, and a few others follow this model. That's going to give you a true risk-free shot at approval. Now, when it comes to credit cards, the big banks are where most people start, and for good reason. These are the cards that often come with high limits and big intro bonuses like 0% APR promos and rewards that actually make a difference. But not all banks play fair, and some change the rules without warning. And speaking of that, here are some consistently available pre-approval tools. These banks are the reliable players, and they made pre-approval part of their normal process. First one is American Express. This was a favorite and for good reason. Your first Amex card will usually pull Experian and sometimes TransUnion, so be ready for that. But here's the secret sauce. Every card you apply for after that is only a soft pull. So once you're in the Amex ecosystem, it's like you've unlocked a cheat code. You can stack cards, grow limits and earn rewards all without taking another hit to your score. Then you got Discover, Citi, Capital One, and Bank of America. These banks have kept their pre-qualification or pre-approval tool live for years. They're the tried and true pass for anyone looking to test the waters without diving in head first. And Discover and Citi offer real simple forms you can fill out in under 2 minutes. And the Capital One Venture X card deserves its own spotlight. It has a dedicated pre-qualification path, and unlike other Capital One cards that might feel like starter cards, the Venture X is a premium card with some serious benefits and high starting limits from 10K to 30K. Now, these are the inconsistent and disappearing pre-approvals that I've seen from time to time. And I gotta say, this does get a little annoying after, years have passed. The first one is Chase. Everyone wants those Chase Ink or Sapphire cards, right? But good luck catching the pre-approval tool online. One day it's up, the next day it's gone. Sometimes they're updating the site. Sometimes it's just poof, no explanation. If you're targeting Chase, you'll need patience and a little luck. So you want to check back regularly or apply based on data points from the credit community. Then there's HSBC, and it's the same story here. Their pre-qualification link goes down often, and even when it's live, it can be buggy. Not exactly confidence inspiring when you're trusting them with your personal data, I know. And just because the big banks are big doesn't mean they're consistent. Always double check the current status of pre-qualification tools, especially for Chase and HSBC and a few others. A lot can change in a month or even a week. Now let's be real, big banks get all the hype, but when it comes to relationship-driven funding, credit unions quietly hold that crown. They don't always have the fancy marketing or huge sign-up bonuses, but what they do offer is loyalty-based love. The longer you're in their system, the more they trust you and the more they start sending you those amazing low-risk offers most big banks won't. And here's what happens after 90 to 180 days. When you stick with a solid credit union for just 3 to 6 months, here's what often starts happening. You start getting pre-approval offers and they start rolling in. And this is not just the you might be eligible stuff. These come with actual APRs, starting limits, and clear terms, meaning your odds of approval are sky high. It's like they're saying, hey, we know you, you're good for it, let's work together. Even better, many of these offers are soft pull only, and so there's no hit to your credit. And these are some of the best credit unions that are consistently showing up for members with early soft pull and pre-approval love. First is BECU, or Boeing Employees Credit Union. Then there's DCU, or Digital Federal Credit Union, Wings Financial, and then Unify Credit Union. And here's the best part. Some of them will start serving you these offers almost immediately after membership approval. That's right, on day one. Now, if you want to increase your chance of seeing those really good offers faster, here's what works. You want to set up direct deposit first. Nothing says that I'm serious like having your paycheck land there in the account. It really builds trust fast. Then you want to show light usage. Use your debit card, move small funds in and out, pay a bill or two through them. This is when you're signaling to the credit union, I'm active, I'm engaged, and I'm worth betting on. And in a world of constant algorithm-driven underwriting and bots deciding your fate, there's something powerful about real relationships leading to real results. So if you're tired of being just another number at a big bank, maybe it's time to go where membership is where it actually means something. Now, before I get into the Fintech credit cards, make sure you hit the subscribe button to let me know that you want to see more content like this. And this is the only way I know for sure that I'm creating the right content just for you. So moving on, sometimes the traditional route to building credit feels like trying to get into an exclusive club without knowing the dress code. You got decent income, your bills are paid, but if your FICO score isn't great, the banks just won't even look your way. That's where Fintech credit cards come in. These are kind of disruptors, they're the rule breakers trying to undercut the big banks. So instead of judging you based on your FICO score alone, which can be unfairly punishing, many fintechs look at your real life financial behavior. They do things like link your bank account to show responsible cash flow. They sometimes check income and spending patterns. And there's no hard credit pull required in many cases. It's really kind of a refreshing shift, especially if you're rebuilding or bouncing back or just want to protect your credit profile from unnecessary inquiries. And you often see underwriters like WebBank or Celtic Bank behind these cards. And some cards that you want to watch out that are coming about recently are the Gemini crypto card. So if you're a fan of crypto, then Gemini might be a perfect match for you. You can earn rewards in Bitcoin, Ethereum, Solana, and more stable coins, even when your credit score fluctuates. And I've seen people loving this one because they're predictable and not playing games like sudden limit cuts or shady account closures. It's really attractive for folks who want to grow long-term credit lines and still dip a toe into that crypto space. And the best part is Gemini shows your starting credit limit before you hit accept. Another one is the Apple Card, which I mentioned earlier, and that's backed by Goldman Sachs right now. This card was designed for Apple users, but there's a lot more to it than just a shiny titanium and, 3% cash back on MacBooks. It's really good for utilization padding. So many people work this card up to, 20, even 30K plus limits. And the approval process is a soft pull until you accept. And it's managed entirely on your iPhone, so it's, user friendly. But again, what makes it truly stand out is that Apple shows your starting limit up front before you commit. That means you're in full control and you get to see your exact credit limit and terms before you make a decision. So if you like what you see, you can accept the offer and take the hard pull. But if you don't like it, you can just walk away, no hit to your credit, no wasted inquiry. And this is exactly how applying for credit should be. It should be transparent, risk-free until you're ready. And you should be able to call all the shots. All right, now let's talk about store credit cards. The kind where you're offered at checkout right after buying a hammer or a new mattress or half of IKEA. They can seem tempting in the moment. Sign up today and get 20% off your purchase. I know it sounds like a win, right? But behind that discount often hides the fine print, with real consequences. You really want to be aware of Comenity and Synchrony Bank. If you're considering a store card, here's the part they don't tell you in the sales pitch. These two, Comenity and Synchrony, are notorious for slashing credit limits without warning, even if you've never missed a payment and you use the card responsibly. Imagine waking up one morning to find out your $10,000 credit limit was cut down to $1,000 or worse, closed entirely. That's not a what if. It happens all the time to people. And this isn't just annoying, it can wreck your utilization ratio and then drop your score and damage your trust with future lenders. Oh, and if you're trying to dispute it, good luck. Most of these cards come with forced arbitration clauses, making it nearly impossible to fight back in court. It's like you're dating someone who ghosts you for no reason. You never saw it coming. Now, not all store cards are traps. If you shop at certain retailers frequently, some of those store cards can become powerful tools in your wallet. Think of something like the Lowe's card. That's a heavy hitter with credit limits reaching 90 plus K, especially for those in real estate, construction, or, do-it-yourself remodeling. Plus, they offer periodic, special financing promotions and deep in-store discounts. And then there's the Home Depot card. That's similar to Lowe's. It grows with usage and it rewards you with retail perks like exclusive discounts, cashback events, and limited time offers just for their cardholders. And I gotta say, I also like the Amazon Store card. It's ideal for frequent Amazon shoppers. Prime members earn 5% back on Amazon purchases, and it offers special financing options like 0% interest for 6, 12, and 24 months on those eligible purchases. But that's provided that the balance is paid in full within that promotional period. I found that credit limits here can vary. Initial limits can be as low as $150, but some users have reported increases up to $10,000 over time. And I know this one is still backed by Synchrony Bank, but this one can still be a must-have. But I want to warn you, only apply if you're a frequent shopper. I think the golden rule is that if you don't shop there regularly, don't get the card. I know that 15% sign-up discount, it's not worth it if you're never going back there. So instead, use that approval opportunity to get a flexible card that works everywhere and it grows with you. But if you're a regular at Lowe's, Home Depot, or Amazon, and you can stack the card perks with, your real-world spending, then hey, this might just be the right play. But store cards can be hit or miss. Sometimes they're useful, but most of the time, they lock you into one place with low limits and no real flexibility. But one financial institution is always a sure bet. And that's Navy Federal Credit Union. That is, if you can get in the door. But once you're in, you're looking at a real approval. I'm talking big boy limits, 10K, 25K, even $50,000+ with real buying power. So check out the next video right here to learn how to get approved, even with bad credit, and the secret scoring system Navy Federal uses to approve your applications. Thank you for watching.